Hey everyone, welcome. Today, we're going to break down some of the top mutual funds to look at for 2026, and we're doing it with real hard numbers. No fluff, no hype. We're talking NAV, AUM, and actual returns data so you can see exactly what's going on under the hood.
So let's just get right to it. I bet this is the biggest question on your mind right now. After a total roller coaster of a year in 2025, where on earth do you put your hard-earned money? It's a great question. And the answer isn't about finding some single magic fund. It's about building a really smart, rock-solid strategy.
All right, so here's our game plan. First, we'll lay out the big picture strategy for 2026. Then, we're going to build our portfolio piece by piece, starting with that stable large cap core, adding in an adaptive flexi cap layer, and then kicking it up a notch with a high growth satellite portion. And finally, we'll pull it all together and go over 3 simple rules to make sure it actually works for you. First up, the 2026 investing strategy. So, what's the big idea for the year ahead? It really boils down to one word: discipline. After all the crazy swings we've seen, the pros are expecting returns to get back to normal. And what that means is your strategy is going to be way more important than just chasing whatever's hot. And the way we're going to do that is with a strategy called the core and satellite model. It's a classic for a reason, You build a big, stable core with large, dependable funds for that steady consistency. And then you add a smaller, growth-focused satellite with some higher-risk funds to really give your portfolio some punch. It's this beautiful mix of safety and spice. So here's what that looks like in practice. This is pretty much our blueprint. We're putting about half our money, 50%, into that stable, large-cap core. Then 30% goes into a more adaptable flexi cap core, and that leaves the final 20% for our satellite of mid and small caps to really go for growth. So keep these numbers in your head as we start looking at the actual funds. Okay, let's get building. First up, the absolute foundation of our portfolio, the large cap core. These are the giants, right? The stability engines. They're invested in India's top 100 companies, and they are designed to be the anchor for your investments, no matter what the market is doing. And the first fund we're looking at for this job is the Mirae Asset Large Cap Fund. Let's look at the actual numbers. The net asset value per unit is sitting around 133. Now look at the AUM, that's assets under management, a massive 41,000 crore. That's not just a big number, you guys. That's a huge vote of confidence from investors. And check out the expense ratio, what you pay the fund, a really lean 0.52%. That means more of your money stays working for you. All this has led to a really strong 5-year compound annual growth rate of around 18 to 19%. So why this one? What's so special about it? Well, first, it consistently beats its benchmark, which is kind of the whole point of paying for an active fund, right? Second, that low expense ratio is like a silent hero for your portfolio. Over the years, it saves you an absolute fortune in fees. And third, with that huge AUM, it's super diversified, so you're not overly exposed if one single company has a bad day. Now to pair with that, we've got another heavy hitter, the ICICI Prudential Bluechip Fund. The numbers here are just as powerful, an AV around 126, and just look at that AUM, over 78,000 crore. That is just a staggering amount of trust from the market. The expense ratio is a little higher, sure, but it's backed by a very, very consistent 15 to 16% compound annual growth rate over a full decade. The word that comes to mind here is consistency. This fund has delivered time and again through all sorts of market cycles. We're talking 3, 5, and 10-year periods. And by holding this one and the Mirae fund, you're not putting all your eggs in one basket, right? You're spreading the risk across 2 different fund management teams, which is just a smart move. All right, our foundation is solid. Now it's time to add a bit of, flexibility. This is where flexi caps come in. Think of these as the intelligent all-rounders in your lineup. The fund managers can shift their investments between large, mid, and small cap stocks, basically going wherever they see the best opportunities. And for our first flexi cap, you knew this one was coming, right? It's a huge fan favorite, the Parag Flexi Cap Fund. And the numbers, wow, they really speak for themselves. An AAV of around 95, a mind-boggling AUM of 1.3 lakh crore, that's just massive. The expense ratio is reasonable, and it's delivered a stellar 10-year CAGR of 18 to 19%. That is long-term wealth creation, right there. So what's the secret sauce here? Well, it takes a value-oriented approach. That means it hunts for great companies that are selling at a good price, not just chasing whatever's popular. It's consistently generated alpha, which is just a fancy way of saying it earns extra returns over its benchmark. And what's really cool is it invests in some international stocks, giving your portfolios some global diversification you just wouldn't get otherwise. And for our second Flexi Cap, let's look at a newer, more growth-focused option, the Mirae Asset Flexi Cap Fund. Okay, so this one's a bit newer, so the NAV and AUM are smaller, but what you really need to look at is that expense ratio, just 0.46%. That is incredibly competitive for this category and a huge plus for your long-term growth. And since it launched, it's been delivering a strong compound annual growth rate in that 20 to 22% range, so its growth style is clearly working. Okay, core is built. Time for the fun part. Let's add that little bit of spice, that growth satellite of smaller caps. This is the high-risk, high-reward strike force of our portfolio. And I gotta stress the word risk here. These funds can absolutely supercharge your returns, but boy, they do come with some serious volatility. So for our mid-cap slot, we're looking at the Kotak Emerging Equity Fund. It's kind of known for bringing some consistency to what is usually a very wild category. And just look at these numbers, an NAV around 115 and an unbelievably low expense ratio for this category, under 0.40%. But the returns? That's the real story. A 5-year CAGR anywhere from 24% up to 32% and over 21% every single year since it was launched. That is serious, serious growth. And now for our small cap pick, the SBI Small Cap Fund. And this fund, you guys, is a perfect case study in what small cap investing is really all about. Okay, now this is probably the most important slide for understanding this part of the portfolio. Look here. Look at the 1-year return. It's negative, down 2 to 4%. That's the volatility we were just talking about. But now look at the 5-year and 10-year returns, around 28% and 18% per year. This is small cap investing in a nutshell. You have to have the stomach for the down years to get the incredible long-term rewards. It's a patience game. Phew. Okay, we've looked at all the individual pieces of the puzzle. Now let's step back and put it all together to see what our sample portfolio actually looks like. And boom, here's how it all comes together. You can see our whole core and satellite strategy right here in action. We've got the Mirae and ICICI funds making up that big, large cap core, Parag and Mirae Flexi as that adaptive core, and then Kotak and SBI as our high-powered satellite growth engines. So just to recap that allocation, we're talking 40 to 50% in that large cap core for stability, 30 to 40% in the flexi cap core for that adaptive growth, and then a carefully controlled 10 to 20% in the mid and small cap satellite to act as a real return booster. But listen, picking great funds is like only half the job. The other half, the really crucial part, is what you do next. Let's talk about 3 simple rules to make your plan actually work, because this is where discipline turns a good idea into great results. And it boils down to 3 super simple but absolutely non-negotiable rules. 1, always invest in direct plans. This cuts out the middleman and saves you up to 1% in fees every year, which adds up to a crazy amount over time. 2, use systematic investment plans, or SIPs. Invest a fixed amount every single month. It forces discipline and averages out your costs. And 3, only review and rebalance your portfolio once a year. That's it. It stops you from panic selling or buying based on scary news headlines. And if you're ever thinking, does this little bit every month really matter? Just look at this. A simple 10,000 rupee SIP every month for 5 years at an average 12% return can grow to over 8.5 lakhs. That's the magic of just being disciplined and systematic. Okay, if you take away only one thing from this whole explainer, let it be this. These funds have strong past numbers, but 2026 can be different. Use them as tools inside a disciplined plan, not as guaranteed shortcuts. Past performance is never, ever a guarantee of what's coming next. Your strategy and your discipline, those are your best friends. So, as always, before you invest a single rupee, please do your own homework. And always check the latest fun fact sheets for the most up-to-date numbers. Hey, if you like this no-hype, numbers-first approach, be sure to subscribe for more. Thanks for watching.